Hi, I'm Tim Kelley, Head of Research at Montgomery Investment Management, and welcome to this week's Video Insight. One of the questions we get asked from time to time is whether now is a good time to put money into the stock market, or whether it might be better to wait. If the market has been rising, the tendency is to want to wait for a pullback. If it's been falling, there's a tendency to want to wait for it to stop falling. We can't blame people for thinking about the market this way, because there are a lot of stock market commentators willing to offer an opinion on where the markets might go in the short term, or to make a prediction about where the market will end the year. Faced with all these experts delivering a solemn prediction about where the market is going, it's natural that people should think that there's some merit to these predictions. And that's where the problem arises, because there isn't any. People who have followed us for a while know that we decline to make these predictions because we believe that it's futile. There has been a great deal of research done that supports our view, and today I want to highlight one particular example of that research undertaken by a man named Philip Tetlock from the University of Pennsylvania and published in 2005. What Tetlock did was to study in a very structured way the predictions of nearly 300 different experts who made their living commenting on political and economic trends. He did this over a period of 20 years and gathered data on more than 80,000 separate expert forecasts. By the end of 20 years, he had the data to draw some fairly definitive conclusions. The conclusions he reached included these. Firstly, he found that, as a general point, expert predictions about complex economic systems are no better than the predictions made by non-experts. And that's consistent with other research that tends to show that if you don't have an expert handy, a dartboard will often serve just as well. Another conclusion that Tetlock drew was a bit more interesting. He found that the reliability of expert predictions actually declined the higher the profile of the expert. In other words, the best-known experts tended to be more overconfident and to do worse than the ones who stayed further away from the limelight. I think that the conclusion that flows from this is that the experts who enjoy the highest profile on TV or in the newspapers didn't necessarily get there because of their expertise. It might just be that they're there because they're good entertainers. All too often, nobody is keeping score, and the experts can get away with poor quality predictions year after year without being called to account. There will be exceptions to the rule, of course, and there are a lot of experts in different fields that we pay close attention to. But as a general point, we don't feel that we should make predictions about where the market is going short term, and we think you should be skeptical of those sorts of predictions when you hear them. When it comes to timing, what we do know is that when equities are cheap, that's a good time to be buying them. We can't promise results in the short term, but in the long run, we're confident of doing well. That's it for this week. We'll be back with more insights in the weeks ahead, and in the meantime, remember you can follow us on Facebook or on Twitter.